Hi and welcome to What's in Store, where we receive today Paolo Temporiti, Head of GoToMarket for Italy and Southeastern Europe at Worldline TSS, to better understand the impact of the digital acceleration specifically for the Italian market. Hi Paolo and welcome to What's in Store. Like other countries in the world, and we've seen this with France in the last episode with Fabien Darnay, COVID was a great accelerator for digital transformation, and we've seen a rise in digital payments. But Italy is very well known for having a strong cash culture. So could you tell us, what's your reaction? What have you noticed in your particular market in Italy?
Italy certainly is very much cash dominated in terms of country and in terms of economies, and like many other European markets and eventually global markets, we have seen a dramatic boost in e-money on the back of the pandemic. It was probably, talking obviously with a lens that is almost dedicated to our industry, it was probably one of the few positive things, if I may call it in this way, that has been happened on the back of the pandemic. So we had a number of increased transactions around CLS. We got government initiatives that have tried to boost card usage. We have seen e-commerce grown in a fantastic way. We have seen double-digit growth around mobile devices and wearable devices transaction. So I would say a very similar path to the one that has happened across Europe, and we're still living it. We are experiencing this tailwind even in 2021, but certainly the beginning of this tailwind was on the back of the end of the first quarter of 2020, when the pandemic was coming in all its strength in the country.
How does this need for smart and digital payment systems, the need for omnichannel offer, impact the Italian market?
Let me put this into the following perspective. Italy, like any other market, and if we look at it in the wider context of the European landscape, has also experienced a pretty aggressive and strong M&A activities. So the number of operators in the market has certainly decreased. We have a couple of very large operators concentrating the traffic and the transactions, the units, the devices, meaning the POS devices in our cases, or the ATMs even, under their own hands and under their own umbrella. This has basically led the industry to become certainly perceived as a commoditized type of business, which obviously has forced these big operators and also newcomers to focus on innovation. And in order to drive and bring innovation to the market, you need obviously to leverage much more smart devices, value-added services, apps, whatever obviously brings more value within the payment transaction. And so, by no means, certainly Italy has started to surf this technology wave, if I may call it in this way. And obviously we're not yet there. We are not certainly leading the innovation, I would say, race. Certainly there are markets around the world that are much more advanced than us, but the demand is there. The rise of Android is, for instance, is a good example in this respect. The rise in terms of demand, curiosity, and attention around it, especially the perspective out of which clients are looking at Android, meaning they are not looking at Android as, and obviously Android devices, not as devices that they're going to run and use just for payment purposes. That is not going to be probably the smartest way to use those kind of devices, but they are going to look at them in order to deploy value-added services to their merchant community in order to create and leverage a much more, I would say, robust and solid relationship with them.
You mentioned consolidation, and my next question is your reaction regarding Nex's consolidation with Nets, but also SIA now. Consolidation has swept through the fast-expanding payment industry. Would you say it is the post-pandemic that has accelerated this trend, or was it already there?
I think it was already there. We have experienced and witnessed this trend since a few years ago. It came obviously initially from the United States with very large merge over there, and then it came to Europe. And the example you made fall exactly in this league. I believe, generally speaking, the payment business in itself is a volume game. You need scale and you need volumes. And at some point, in order to jump to the next level, an M&A jump gives you what you need. Now, with M&A, several challenges are coming. First of all, an entity that acquires another one will have to try to harmonize technology and systems in order to be in a position to build solutions and services in one place and deploying it in all the other places in which it operates. It has obviously the need to harmonize its product offering, and consolidating and integrating different companies in terms of product solutions and culture is not always easy. But the trend is definitely there. And so Next is obviously on the back of the move they made, is going to become one of the largest operators in Europe, and obviously is going to consolidate its position on the back of the SEE acquisition as the Italian champion in this respect. Now, interestingly enough, these kind of acquisitions are partially addressing the top line growth that this entity have to secure, and are also partially addressing the cost synergies that they need to secure as well. So any partner that is going to be in a position to work with these guys in order to facilitate both streams, meaning the top line growth and improvements, as well as the ability to harmonize, optimize, and efficientize their operational value chain, will definitely be welcome and will definitely be selected as one of the prime partners these companies are going to work with.
And would you say that those consolidations, this type of consolidation, explain why SaaS models are rising? I mean, Ingenico is launching in the next fall in autumn its payment platform as a service. Would you say that this kind of consolidation within acquirers in the market enables this kind of models?
Yeah, absolutely. I think that more than the as a service type of commercial agreement that we are going to strike, and the philosophy out of which the payment platform as a service is based in, it's the value of the overall proposition behind payment platform as a service that triggers exactly all the points I was making before. It is going to be a software enabler and a software facilitator that will allow our partners to deploy in a much more harmonized and streamlined and smooth way all the services across the value chain of their merchant book, across the various geographies, and being based on a software as a service model could eventually be much faster to deploy it, much faster to integrate it, because it's going to be based on public APIs, which is certainly an element that when you merge different entities with different legacy, it's what concerns and worries you, because very old legacy systems are very difficult to talk one after each other, to integrate one after each other, and certainly the investment behind those kind of integration are very big, and you don't want to invest on a very old technology or on a vintage technology. On the other end, leveraging something like we are building and deploying and we have announced back in March, I think makes a lot of sense, as the ability to execute and be deployed in a hardware agnostic way, which is also a plus. I would consider it at least as a big plus, and is going to hit exactly the need and the wants of our client portfolio.
Excellent. Thank you very much, Paolo, for being with us today on this episode of What's in Store.